Bang! Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem on how to properly report a merchandising income statement. So if you're unfamiliar with income statements, don't fret gang, I dropped the link to get you up to speed in no time. So with that being said, let's get it. So it tells us Camellia Communications reported the following figures from its adjusted trial balance for the year, its first year of business, which ended on July 31st. All right, so we have a table here. We can put that right here. It gives us a bunch of information, and it wants us to prepare Camellia's Communications multi-step income statement for the year. Okay, gang. So we are dealing with the multi-step income statement. And the multi-step income statement is just yet another formal suit and tie version that is much more descriptive than the single-step income statement for viewers to make sound decisions. Now, we know the single-step income statement is easy, gang. We just add up all our revenues and subtract all of our expenses. A lot of times they're done in descending order, and then we get net income. But now we're dealing with a multi-step, which means that there are several steps that we go through to get to our net income. So with the multi-step income statement, our first calculation is going to be gross profit. And we know that gross profit is simply sales minus cost of goods sold. After we get our gross profit gain, we are then ordered to subtract our operating expenses. And we know that our operating expenses are those expenses that are incurred based on operations, which consist of general administrative expenses, selling expenses, research and development, and restructuring costs. After we subtract those particular operating expenses, we get operating income. Once we get our operating income, we are going to add or subtract the other income/expenses that are considered non-operated. And after we make those adjustments, we are now moving over to our net income, gang, at this particular point in time. But once we tackle intermediate accounting, we unlock a whole nother animal in terms of reporting our income statement.
I show you how deep the rabbit hole goes.
But never mind that, let's focus on this problem. So let's identify each one of these accounts and first decide what financial statement it belongs on. Okay, cash is obviously an asset gain, so we know that's on the balance sheet. Selling expenses happens to be on the income statement because it's an expense, and particularly selling expenses are operating expenses. Accounts payable, common stock, and notes payable all belong on the balance sheet. Accounts payable is a short-term liability, common stock is a part of equity, and notes payable is a long-term liability. Merchandise inventory is also on the balance sheet, labeled as a current asset. Remember, gang, our current assets are those assets that are going to be converted into cash in less than a year operating cycle, as well as our current liabilities being those liabilities that we pay off within a year. Our administrative expenses are also considered operating expenses. Estimated returns on inventory is a current asset. Our cost of goods sold, one of the most important expenses, which will help us calculate gross profit on our income statement. Equipment is an asset, long-term PP&E account. Salaries payable is a current liability. Our net sales revenue we know belongs on the income statement. Accounts receivable is a current asset, henceforth the balance sheet. Interest expense is considered a part of the income statement in the other section, gang. Refunds payable is a liability, obviously a current liability that is. And sales discount fortified will also be included in the other section of our income statement. So let's get to rocking and rolling. So first at the bat is going to be our sales revenue. Next we're going to subtract our cost of goods sold to calculate our gross profit. As we can see, we have a gross profit as of right now of $97.50. We then will add up our operating expenses, then subtract it from gross profit to get our operating income. We saw that we had two operating expenses of selling and administrative, so we're going to report those. When we subtract our total operating expenses of $4,700 from our gross profit of $97.50, we get an operating income of $5,050. And then we're going to add and subtract the other expense and income items. We saw that we had a sales discount fortified, which would be added to our income. And we also saw that we had an interest expense, which will be deducted from our income. So we're going to report those amounts. When we net our interest expense to our sales discount, we get a total other income of $685, which must be subtracted from our operating income, which will give us our
3 days later.
net income amount of $5,735. We're going to check the answer. Fantastic. So there you have it, gang. A quick, easy illustration of how to properly report the multi-step income statement for a merchandising company. So if that light bulb clicked upstairs and you're closer to chasing the bag with this accounting information, hit the like button, hit the subscribe button, and share the channel with your friends so they can get it too. As always, gang, I'm Dr. Who, and I love the time that you share with me, and I will see you soon. Bags!